So Donald Trump announced tariffs for different countries, and that was a good opportunity for me to buy some stocks. I analyzed a lot of different stocks, and I analyzed Google, and I found it was a good opportunity to buy at that time. The price of Google was around this number, and I sold it for $395 per share, making a profit of around 130%. Why did I actually sell Google stock? What was the reason for this decision? After all, if this stock is performing so well, why don't I hold it for a longer period? I'll explain later in this video. And before we start this topic, I would just want to say welcome to all the new subscribers, and I hope you have a good time here. If you find this channel and this video useful, please subscribe. I would really appreciate your support, and this keeps me going for uploading content like this. Before buying actually Google, it took me around 20 hours to analyze this company. I read the 10K report, I looked at the financial statements, I looked at the competitors Google have, so I can make this decision. And I also calculated a fair price for me. And I made the decision, I bought Google stock, and before I purchased the car, I sold all of my Google stocks. And the reason I'm selling this is because all these companies, they take time for you to analyze. And it's not just buying the company. So you have to be constantly updated on the company. It's the quarterly reports, the 10K reports, and the direction this company is heading. If you're believing this direction is good, then you obviously keep the company. But if the direction you're going does not suit your needs, your beliefs, then probably it's time to sell. So if this company took me 20 hours to analyze and have a decision, if I have 10 companies in my portfolio, that's 1,200 hours spent on analyzing a company. You could be better off spending this time with your family or with your friends or going to conferences or maybe getting better at your job. This is the opportunity cost. The much better alternative is to have an index fund. This is a passive strategy. What you do is you buy this index fund every month and you let it grow. Obviously, the index fund doesn't have the return of a single stock, but it doesn't bear the same risk. If the stock goes bust, you obviously lose all your investment. Whereas the index fund, if one of the companies, let's take, for example, S&P 500 as an index fund, if one of the companies goes bust, another one replaces the index. And even though there may be partial decline in the price of the index, it will increase in the long term. There were some articles I read about putting a stop loss on Google. Stop loss means setting a price that you're willing to sell the company if it goes down. Actually, Warren Buffett has an interesting interpretation of stop loss. If you have a house which is valued at $100,000 and you want to sell it, you would sell it at $100,000, or you would put a stop loss at 10% and sell it at $90,000 when the market drops. Of course, you're going to sell it at $100,000. So I'm not saying that you should stop buying stocks. If you have the time and energy, and obviously the intelligence, financial intelligence, to do these kind of decisions, obviously go ahead. But bear in mind that when I started learning about investing and buying stocks, there were opportunities in eToro, for example, to copy portfolios. Well, copying portfolios is a bad idea. It's much more better for you to have the time to put the energy and the time to learn how financial markets work, how prices are affected by demand, supply, what are some ratios to estimate if a company is undervalued or overvalued. Obviously understand all the financial statements. Balance sheet, cash flow, and income statement are very important. And my advice to all of you is do not listen to anyone who tells you to buy Google today or Google tomorrow. You have to learn this. You have to have this decision. You have to make this decision yourself. Do not copy others, do not listen to advice from others. You need to put the effort, put the work, and then start making decisions. And I'll tell you, you will make wrong decisions, but this will be your decisions, your mistakes, and you learn from them. Because copying from a portfolio, from someone who have a different horizon from you, different risk appetite, you don't know even if he's a risky player, speculative player, it's a very risky strategy. And even though it may show a high return over 1 or 2 years, we as long investors are looking for at least 10 years horizon. So we need to be focused on that goal. We need to be focused on this financial intelligence and looking at the long-term perspective. Also, if you want to understand more about how I decided buying a car, what was my main thinking, you could watch this video as well. And before I finish, I just want to say that nothing in this video or in this channel offers a financial or can be used as a financial or investment advice. Always do your own research, be critical of everything I say, and the others obviously. Thank you for your patience and for your time. Have a good one.